All right. Welcome, everyone, to this Amphil Scotch talk on the intersection of fundraising and finance. We will start to get going here in a little bit with our guest, Walt Coughlin, who's coming to us from the Denver area. I'm Jeremy Beer. I'm the CEO at Amphil, and I'm coming to you from Phoenix today. Those of you who have joined us before for one of these Scotch talks, the idea, the conceit of these talks is that they're informal, late afternoon, a drink in your hand, let's just have a conversation kinds of events. So the rule is I always have to have a real drink, which always makes me look like a real alcoholic because it's only 1 o'clock my time on a Wednesday. But I'm not having Scotch. I almost never have Scotch on these Scotch talks. I have some Stodel, which is kind of like mezcal or tequila that's from Hacienda Chihuahua, and I would highly recommend it if you're interested. Walt, I don't know if I'm going to introduce you here in a second, but are you drinking with us today, or are you?
Unfortunately, I'm just drinking a blue blackberry bubbly, so not as exciting as what you
Okay.
have,
No,
but
that's
refreshing.
well. The guest often refrains from partaking, I notice, so which is probably wise on
Yes.
the guest part. So um, we're going to talk about the intersection of fundraising and finance. I'm going to introduce Walt here in a second uh, and what he does, and then this is just we're going to see if we can answer um, not only answer some questions and put some new ideas, which might be new ideas into your mind about how to go about financing needs for your nonprofit organization. Before we do that, a couple of rules of the road. Number one, if you want to ask a question, we want to hear your questions. So the best place to put those, the easiest place for me to monitor them is using the Q&A function at the bottom of your Zoom screen. Just put something in there, or you can just put it in the chat. I'll try to catch it in the chat as well. Either one. Q&A is a little bit more formal. And then if you don't mind, tell us who you are in the chat. Tell us who you are, what your role is, and who you're with. Actually, I'd love to get that just because I kind of, if I see something in there, I often can kind of steer a conversation toward something I guess might be more relevant to you. So love to hear from you and know who we're talking to. Otherwise, it's like Walt and I talking to each other and like to the void. And if you've ever done one of these on this side, it's like it's way more fun to know who it is you're talking to. Thank you, Daniel Smith, for breaking the ice in the chat. Love the Dominican House of Studies. Happy to have you with us. Great. All right, let me introduce our guest here. Walt uh, Coughlin is third generation executive in his family business. Coughlin and Company, founded in 1932, which is it's coming up in your 100th anniversary, Walt.
Very close.
I would
Yep.
imagine preparations will start soon. I guess we're 9 years out still, but that's really impressive.
We'll have
Um,
Scotch on that anniversary, no doubt.
Absolutely. We're going to talk today with Walt about cutting edge ways that nonprofits can save money through the intersection of fundraising and finance. We'll unpack what that means. We're going to discuss something called balance sheet philanthropy, which is a concept that Walt actually introduced me to when we first met earlier this year, including a legacy income financing trust program or LIFT program, donor bonds, other tax saving ways for donors to give. So that's kind of the territory we're covering here today. Very different for us. We've never covered this topic or anything really close to it, I don't think, in the hundreds of Scotch Talks, webinars, podcasts we've done in the last 3 years. So I'm excited about it. I am coming at this as someone with a lot to learn. This is way outside my bailiwick. Sometimes I'm asking like naive questions to our guests on these Scotch Talks just to draw them out more. The questions I ask today will truly be naive. I don't know the answers. So I look forward to learning them along with you. All right, a little bit more about Walt. He has been with Coughlin and Company since 1990. Helps a nationwide network of nonprofit and faith-based borrowers design, structure, and complete tax-exempt and taxable financing. He's done this over 150 times, totaling more than $1 billion for schools, healthcare facilities, affordable housing communities, churches, and many other worthy projects. So if you fit one of those categories, you're going to feel at home. Walt is a Stanford graduate, degree in economics, then went to the Kellogg School of Management at Northwestern, where he got his MBA. If you know anything about those institutions, which I imagine you do, like that's impressive, very impressive. Then he went to Solomon Brothers for 4 years in the investment banking department. So we have somebody here who knows what he's talking about. Walt is on the board of a couple of high schools in Denver, or the Denver area, I assume. Is that correct, Walt? Both of those
Yes.
are in. He's a member of the Archdiocese of Denver Finance Council, the Investment Committee of the Catholic Foundation of Northern Colorado. Also, past chairman of Mercy Housing Colorado, which develops low-income housing, Safe House Denver, and Donor Alliance, which is the organ and tissue bank for Colorado and Wyoming. So, someone who himself straddles the world of nonprofits, governance, and finance. So, Walt Coughlin, welcome. Thank you
Thank you.
so much for taking time to join us.
Thanks. I appreciate this opportunity.
This will be fun. We'll get going here. And again, if you have questions for us as we get going, please let us know. Let's start like really, really simple, Walt. How you're a nonprofit organization. How do you finance? What are the options available to you? Assuming you don't just have cash in the bank, that's essentially, or at least you don't want to spend the cash you have in the bank. How do you finance projects that your nonprofit needs?
Sure. So as I always say, my job is we're an investment banker. So I know people that have money and people that need money, and I try and bring them together for the best benefit of both. So there's lenders who want to be involved with you, and they want to be involved with your great projects for a variety of reasons. You do good things in your community. They think they'll be paid back. They support your cause. And you need them because they have the financial resources that will allow you to build your dream project or refinance your dream project or whatever it is. So what we're trying to do is get, two folks that should be working together to work together in the best possible way. So we always say when you're financing your project, there's basically three ways you can do it. So, and it's usually a combination of these things. So as you mentioned, Jeremy, if you have cash, that's great. So maybe that's literally cash. Maybe it's an investment portfolio, endowment fund, something you've had the good fortune to build up over time. Or maybe it's real estate. You just own something that has inherent value. But a lot of times that's not enough, or maybe you actually don't want to liquidate your investment portfolio because it's done so well over time. So one source is, cash you can put in from your own resources, whatever those may be. Second is, I think a lot of the folks on the call are development folks. So, fundraising, certainly that's a way that a lot of folks pay for a portion or all of their projects. So it could be a capital campaign, could be planned giving, which I think we're going to explore further. Could be an annual fund, golf tournaments, whatever it is. And then finally, when we come in, is to help kind of, if there's a shortage, all those things can come together. So maybe we can help you find a loan from a bank. We're doing that. We've done that many times. If you're a nonprofit, the good news is you can do what's called tax-exempt financing, which we can explore further as well. And the reason you may want to consider that is it's probably going to lower the cost of your borrowing by about 20%, which is huge. So if you had a 6% interest rate, that would go down to 4.8. So that's a massive difference in terms of the cost of funding that you're going to endure or achieve, I guess. And then finally, you kind of teased a little about some of these balance sheet philanthropy and planned giving ideas. So we think we have some interesting ways that our clients have been able to access some of their donors and supporters in a way that's great for the donor and supporter and really fits in well with what the nonprofit's trying to do. So those are just some of the ideas, Jeremy.
That's great. We're going to unpack.
Done.
That's fantastic. So it's good. You kind of frame things up for people like, hey, there's lots of ways to pay for some special project. You got a new building, you're a startup school, you're trying to expand the housing for transitional age foster youth to go to something somebody in our chat is doing. If you don't just have the cash, or you don't feel like you can go raise the $5 million in a capital campaign, for whatever reason, we can come back to that. This is when financing comes into play, or of course it can come into play regardless, but that's often when it could come into play. Unpack, like, how do you, everybody knows you can go to a bank for a loan, but what's this tax exempt financing thing? I don't think it's possible that most of these development people don't know that if you're a nonprofit organization, you can really knock down the interest rate significantly. What qualifications do you have to meet? Do you have to be really big for that to be an option? What collateral do
Now,
you need? Like, how do you start to access that kind of financing?
sure. So one of the things that helps if you're seeking outside third-party financing, like from a bank or tax-exempt financing, sometimes it helps to have someone shoulder to shoulder with you that's done it before. Just
Mhm.
because banks look at the world in a different way, just as the folks in your organization, you look at the world in whatever lens you have. So
Yeah,
a bank's going to want to see certain things, and if you can persuasively provide those things to them, you're going to have a much greater chance of success. So
got
I
it.
always tease that people in my business, we speak bank. It's one of our languages. So I think that can sometimes be helpful. Um, but nonprofit or tax exempt financing is really available to any 501c3, and it needs to be for a capital project. So if you're building a school or transitional housing, like you mentioned, or something like that, then you can access tax exempt financing. It really is no different than just a regular loan, other than the fantastic advantage, like I said, that because the person who's provided the money doesn't have to pay income tax on the income they get back from you via your interest rate, they can offer you a lower rate, usually 20% lower because that's their tax rate. Doesn't hurt them because they get the same after-tax return, but you get a 20% lower payment. So,
Mm.
as we said before, that's a huge difference. And when you're setting up budgets or tuition or program charges or whatever, sure helps if one of the big items on your budget list can go down by 20%.
And is it always from a bank where you
No,
access this kind of? Okay. What are the
no.
other ways to access that kind of financing?
So you can do it a variety of ways. So a bank is pretty common, particularly for startups. And banks as I said, like to be involved in their community. So they're a pretty good place to start. And banks are still pretty competitive, although the landscaping is get a little bit tougher. If
Hmm.
you're a bigger project, you can do what's called a public municipal bond or tax exempt bond. Those
Yeah.
would be more like what people might be familiar with. Maybe your local town issues bonds to pay for their sewers, the local school
Right.
district issues bonds to pay for their buildings, the airport issues bonds to pay for runways, things like that. But if you're a small donor, say under 20, or a small borrower, say under 25
Hmm.
million, I
Hmm.
think that's going to be too expensive and just too difficult to process.
So
And then,
bonds are something to consider if you're above 25 million, basically.
yeah, and then
Okay.
also some of your donors, we've done deals where your donors may buy your bonds because they want to put some of their money to work in an investment, idea. And so they may lend you money. We did one
Right.
transaction where the chair of the board of this university lent them money at 2% tax exempt. So he was happy with the investment, and 2% for the university was, as you might imagine, a very good day for them.
So this is an interesting concept. Maybe we can park on this for a second. The donors carrying the paper, so to speak. Is that the right terminology, by the
Yeah.
way?
Yeah.
Excellent.
So
How
what
does
they
that
did
work?
here.
Yeah.
Yeah. So it was an interesting idea. So this was a university that was building a nurse training center. And this particular person had given them a $5 million pledge, $1 million a year for 5 years. Um, and they said, that's really nice. We appreciate it. But if we could start building the nurse training center today, rather than waiting 5 years for your money to come in, that would be
Mhm.
even better. And the donor said, yeah, that'd be great. And I have these monies I need to invest. So I'll tell you what, I'll buy a 2% tax exempt bond issued by you. Every year, I'll give you the $1 million pledge payment, and you use that to pay me back. So it was a win-win. The university got the money to build the nurse training center today. They knew how they're going to pay back the debt because they trusted the board chair. Board chair was
Mhm.
thrilled. He got to see this nurse training center go up today rather than waiting 5 years, and he knew he was going to pay himself back, and he was pleased with the 2% tax exempt return. So it was,
Because the
from
nurse
every
training
point
center
of view, it was
itself
a win.
generates. Yeah. So in this example, the nurse training center itself generates revenue. Is that
Yeah,
correct? Right.
correct.
So that's how the
Yeah.
nonprofit is. So they know they're going to generate the revenue. It makes it well worth the 2% interest they're paying on the. Like, is there a reason why any nonprofit? So let's say you got schools are such a good example. We see this all the time in our own work or church. I can imagine the same thing. Um, yeah, hey, it's 5 million for this new building. We have a pledge or think we can get a pledge. Um, is it a good idea to even just go to a donor and say, hey, what
Sure. I
just
think so. I
start
mean,
with asking for the loan, you know?
yeah, no, it's obviously better if you can lend from, friends and family than from a
Yeah.
disinterested third party. So I think Some people have used this, no doubt, but I think a lot of people just aren't aware that this is a possibility. But what we found is, if you ask someone to write a check, they can write a check this big, but usually they have a portfolio of investments that's this
Right.
big, and they're
Right.
investing in that something now, treasury bills, corporate bonds, whatever. So my sense is they just as soon invest in a project they love at the school or the homeless shelter, or whatever, than they would a corporate bond or a treasury security or whatever. So I don't know.
And I
I just
suppose
think
that
it's, go ahead.
today's interest rates getting 4%, rather,
Yeah.
from a donor that's still like not a totally negligible return, like 2%
No.
might be, yet still 2-3% below where the market is now.
Yeah. Yeah. And again, they can see the fruit of their investment,
Yeah.
come about because the project happens today rather
Right.
than later.
Right.
And, presumably this is a institution they love and want to succeed. So this is a way they can really accelerate that happening.
Yeah. They see success
Yeah,
sooner, which I would think even loses the philanthropic side of the pocketbook even more as you move forward. Um,
absolutely.
is it hard to do that, do that kind of this private bond transaction?
No, when we did it for this university, I think we started, give or take, the 1st of November a couple years ago. And as I recall, we were done about the middle of December. So if you have, interested parties that are, moving at a reasonable clip, you can get it done probably within 1 to 3 months. And you can also get a variety of folks involved in this. So it doesn't just have to be one to
Right.
one. It
Doesn't
could
just be one
be,
person.
right.
Yeah.
You could say we're going to do a $10 million deal, and Jeremy will
Mhm.
take 2 million and Walt will take 1 million, and we kind of cobble it together. The other thing too is you can say we're going to raise 10 million over time, but
Mhm.
we don't necessarily know where that whole 10 million is coming. So we're going to start with 1 million today and maybe 2 million 6 months from now, and ease our way into it. So
Hmm.
it's a really, really flexible way to get money today, but also set yourself up as you find donors and interested parties, down the road.
Is that really risky? I wonder. I would imagine some people listening to this might say, "Oh boy, that sounds really risky." In your experience, do you see a lot of these things stall out halfway through, and with a framed up building sitting around and
No,
nobody doing anything?
no, fortunately, and I hate to say this, but I've been doing this for 30 years, and I'm knocking on every piece of wood
Yeah.
I can find. But I personally and hasn't have never had a transaction that hasn't paid on time in the right amount, et cetera. Again, that could change as soon as we hang up on this call. But
I hope
at
not for
least
your
in my
sake.
experience, these deals do pretty darn well.
What's the current state of nonprofit financing? Is it how would you describe sort of where things are today in this arena?
Well, in some ways, it's becoming more prominent or more important because I'll just give you a couple examples. I'm on the board of a Rupe Jesuit, which is a Cristo Rey school here in Denver, and we're doing a building project. When we started looking at this a couple years ago, we thought it was going to cost 20 million.
Hmm.
It turns out that it's going to cost 40 million just because of increase in construction costs. So what that means is, we were pretty confident we could raise 20 million. We're less confident we can raise 40 million. Maybe we will, maybe we won't. We're sure going to try hard, but perhaps if we don't get to 440 million, maybe we need to do some sort of financing to help fill the gaps. So, 2 years ago, we wouldn't have had this conversation because there would be no gap to fill. So we're definitely seeing that because of construction costs,
Right.
that people are thinking about where am I going to get the money to fill these gaps. The other thing too is, people want to get going on projects. It's no fun to raise money from someone and say, come back in 3 or 4 years and we'll be breaking ground. So we worked on
Right.
another school here in Denver where we got a bridge loan. So they basically, as if they need the money to pay for construction, they'd borrow under the bridge loan. As they got capital campaign pledges, they'd pay it down. Needed money for construction, borrow, pay down, borrow, pay down. So it meant that they could get going on the project today, which they were thrilled about because the school really, really needed to replace some facilities that were in many cases 60 or 70 years old. So, without this
Yeah.
idea, which is not too risky for the school,
Yeah.
they'd still be waiting around, and the students wouldn't be benefiting from this new facilities.
Yeah, I've heard of a number of schools. Recently one that I was talking to in California is a charter. and they've got a big waiting list, and have a big need to build or move into a new facility. I mean, if you have a waiting list, essentially guaranteed income. I think everybody, say their waiting list is 400, and they'd expand. They could even that's even more than they could absorb. Let's say it's 200. Like, does it make any sense not to do this? Like, is it? I mean,
No,
to go into a financing option if you know you've got the revenue sitting there.
no, I think you should. I mean, the other thing too is, and within reason, and with some prudence in mind, nonprofits exist to do good, and it's better to do good now rather than good 5 years from now. So if you have 400 people on a waiting list, it means they want your product. So if you can
Yeah.
accommodate them, sooner rather than later, then you've
Well, I
done
guess think
your
about
job
you're
a lot
right.
better.
Yeah, I like the analogy. I mean, if you just think of this the for-profit world, if I knew I had a waiting list for my product, I would go, and but I just didn't have the cash to make more of it right now, I would go
Yeah,
borrow money, especially if I could do it at a below market rate, so I could make
sure,
more of the product and sell it. And that assumes I have it priced right and so
sure.
forth, and I expect the pipeline to continue. But that would be the analogy, would it not?
Yes, a very good analogy. Yeah, absolutely. That's what for-profit folks do every single day is try and maximize their sales and revenues and meet demand. So yeah, I don't know why
There's
nonprofits wouldn't have that same mentality.
there's a bit of a prejudice, I think, or a preconception in the nonprofit world that debt is like really bad. The financing is really bad. I think. Do you think that's part of what kind of just needs to be
Sure.
overcome to some extent?
Sure. I mean, and it, rightfully so. I mean, no one wants to lose a project because they can't pay back the debt. So, I mean, like I said, hopefully, at least in our case, we've done a decent job of putting together debt that people can pay back, and that the person provided the debt has been paid back as well. So, folks like us have done this a lot. So hopefully, we have a sense of what can happen in the marketplace and can't. The other thing too is, if you go to banks or people like that, I mean, these are professional lenders. So they're going to listen to your story, and odds are they're not going to proceed if they don't think there's a way they're going to get paid back. So the system
And
has
that's
plenty
interesting.
of checks and balances.
Yeah, there's a risk. There's somebody else doing a risk assessment here, not just you.
Exactly.
Yeah,
Yeah.
good point.
So
Do you have other examples of how you given that school example? I don't know if you have any others, but how fundraising and financing have worked kind of
sure,
together for
sure.
somebody.
Yeah. So we did. So those were two. So we did a transaction. This was for a group that provides services on campuses. And they're growing really, really quickly. And so their problem was that they're on 100 campuses, and I'm making up numbers to hide the reality. They
Mhm.
really wanted to be on 150 campuses or 200. Well, that takes money. So what we did is we created this bond, like I described before, where they could issue up to 25 million of bonds, and then the money from that would help them expand onto various campuses. And they have a huge campaign pledge amounts coming in over time, the bequests and wills or whatever. So they were confident if they got the money today from this bond issue, they could expand on campuses. But because of these campaign pledges and wills and bequests, et cetera, there was money coming in over time to pay back the debt. So they were accelerating growth, which is what they wanted to do, but they weren't putting themselves at risk too much
Right.
because again, they were confident in the fundraising mechanisms they had set up. And the donors liked it, again, for kind of the reasons we talked about is, you've asked me for donation after donation after donation, which is great. And now you're asking me, to invest some of my money, which I need to invest anyway. So you've kind of hit me in a different way, which allows me to help you, but it helps me because, I feel like I have a pretty good bond in my portfolio.
Yeah, that's really cool. We have a question from Christina here. And she is our guest who's involved with the transitional aged foster youth in Orange County. She says she's been seeing donor slash grant burnout as a hot topic these days, especially with inflation and the high giving that we saw as a result of the pandemic. As a result, do we foresee financing projects as almost a necessity in the coming years due to those trends? I'm going to take a first crack at answering this. I'll pass it over to you, Paul. Um, I think partly I think that's both true and maybe it could be overdrawn. So giving was down last year. We know in 2022, Um, Giving was down in nominal terms by a couple of percentage points, 4%, I want to say, something like that, in the United States across all sectors. And it was down in real terms, in real dollars, like by 10%. That's a significant drop. Um, I don't think we're going to see it go. It's going to have gone down again in 2023. We won't know until we're well into 2024. Um, you're right, Christina, that there's some evidence of um, a little bit of pullback in the charitable sector. On the other hand, I wouldn't overinterpret that. I mean, sometimes donor burnout, I just have seen with too many clients, it's sort of an excuse for like, we don't really do fundraising that well. We have too small a file. We haven't invested in the right ways from a fund. I'm not saying you guys have done that, but that is sometimes an excuse that executives will pull out. So just keep that in mind. Having said that, though, I think because there's increased need in this country, um, in so many ways, which I don't need to catalog right now, that I think financing, my view, and Walt, what do you think is going to, yes, it's going to become a much more important piece of the how we fund charities puzzle. Walt, what do you think about that?
Yeah, absolutely. In terms of donor fatigue, I mean, I'm on a couple. I donate to a few nonprofits, and you do see, as does everyone, they want to invite you to their golf tournament, and can you sponsor a student, and can you give you the capital campaign, and on and on and on. So at some point, it does feel like I've kind of given you every way I possibly can, but some of these balance sheet ideas we've talked about, is kind of a new and interesting idea. I mean, you've never asked me to look at the asset side of the balance sheet for me, and invest some of my
Yeah.
funds. So maybe that's a good way to do it. The other
Yeah.
reason why I think people like these balance sheet ideas is because you're inherently going after bigger donors. So if someone's going to think of buying one of your bonds, then they have to be a person of means. And if they're a person of means, then maybe they're more apt to listen to this more sophisticated idea or have the resources to participate in, something that's helpful for you and interesting and productive for them as well.
Well, to your point, I want to go back to this balance sheet philanthropy idea and really draw it out, make sure we kind of uh, tie it up for people. Um, One trend that is very true is that the number of people giving seems to be going down in the US or proportionally as a percentage of the population. There's some debate about that. My co-founder, Jeff Kane, thinks maybe we're just not capturing some of that because of like, GoFundMe type things that don't get counted in the data. Nevertheless, we know there's also an increasing separation of the very wealthy from the rest of us. Probably not very healthy socially, in my point of view, but it does mean that more people proportionally are in the position that Walt is describing here, is able to practice a kind of balance sheet philanthropy than perhaps was the case in a generation ago. So balance sheet philanthropy, we didn't. That's not the terminology we used earlier when you were talking about people privately financing things. Is that what we were talking about with balance sheet philanthropy?
Yeah. Yeah. And just to your point, just a couple of statistics that we stumbled across. So if you don't mind sharing them, people always talk about the 80-20 rule,
Yeah.
80% of your donations come from 20% of your donors. So we looked at some statistics, and actually 76% of your donations come from 0.74. So less than 1% of your donors. Those are for people who give 5,000. And
Yeah.
even more starkly, 96.2% of charitable requests come from less than 0.1% of the donors, so 1 in 1,000. So if you want to, go where the pond where the big fish are, then you really need to look at these bigger donors to get the success that you're hoping for.
And one more, I'll give one more stat along these lines. That's something I've been saying a lot lately. What percentage of U.S. GDP is in the charitable sector? So if you just take how much it's given away every year in the U.S. and divide it by total GDP, it's 2.1%. It's basically always 2.1%. It might be 2.0% in the down year, it might be 2.2% in the big year. It's 2.1%. Yeah, like give yourself a way to access the 98% of the economy that's not happening in the charitable sector. And one way to do that is through some of the means we're talking about here. Is there anything else to say on the balance sheet philanthropy
Sure.
side, Bob?
So
Yeah.
I'll just give you one idea. So this is one that we dreamed up. It's called the Legacy Income Financing Trust, or LIFT. So the idea is a lot of people have heard of charitable remainder trusts, hopefully.
Mhm.
But the idea is, I have an appreciated asset. Maybe I bought my building a lot of years ago, and it's now worth a lot. So when I go to sell it, I don't necessarily want to give a huge chunk of the proceeds to my partner, Uncle Sam. So
Hmm.
if I give the appreciated asset to a charitable remainder trust, then I can avoid some capital gains tax. I can get some current income deductions, keep it out of my estate, et cetera. So then once it's in the charitable remainder trust, I get all those wonderful tax benefits. There's now cash in there that needs to be invested. So typically people invest it, or they have, in stocks, bonds, mutual funds, et cetera, which is great. But what we've said is, wouldn't it be great if you bought a bond issued by your favorite nonprofit? So then again, they get the money today for their project. And then, you get an income over the life of the CRT. Then when you die, the remainder is the bond. The bond goes back to the charity. They tear it apart, and it's basically interest-only financing. So when I talked about that entity before that was trying to expand on campuses,
Yeah.
one of the big reasons that they did the transaction I talked about was it gave them access to this charitable remainder trust, or lift idea, whatever you want to call it.
Yeah. So,
So
we're gonna go back through that one more time, because I know from experience that people like you can talk about charitable remainder trust, and they make you've done it so many times. I've heard it 100 times. I'm still always like, I think that's the one that's the crat or the crut or whatever it does this.
yeah,
Um, so you have let's start again. Mr. Smith has a building that he bought for $1 million, and it's now worth 10 million, right?
right.
It's in Denver. Uh, what happens from there? So he sells it to a charitable remainder
Yeah. So
trust. Is
if
that
you
how it
sell,
works?
let's just say, we'll just narrow it down to two alternatives. So he could sell it just in the open market, and he sells it for 10
Mm-hmm.
million. So he had a capital gain of 9 million. So that means, I don't know
Right.
his tax rate, but we'll assume 2 to 3 million of that goes to his partner, Uncle Sam, right? So now he gets whatever the remainder is, 6 or 7
Right.
million.
Mm-hmm.
So that's one way, and that's the way a lot of people do it. But if you took that same asset and put it into a charitable remainder trust, then he doesn't pay capital gains tax. He probably gets a multi-million dollar instant tax deduction today.
Which you can
He
carry
gets,
over for
which you can
years.
carry over.
Yeah.
So he also gets a return on that investment. Let's just say it's 5%. So
Mm-hmm.
every year, if it was a $10 million
Right.
charitable remainder trust, he'd get $500,000.
Yep.
Now he would pay tax on some of that, but nonetheless,
Yeah.
he has that for the term of the charitable remainder trust, which is likely his life. So
Yep.
he has lifetime income. Then when he dies, the remainder, which is this bond in our example,
Yeah.
goes back to the charity, and they tear it up. So they
Incredible.
never have to pay back the principal. So it's great for him. He got lifetime income. He had these incredible tax deductions, and it's great for the charity because they got to build, the Mr. Smith housing project or whatever it is, and they knew they wouldn't
Yeah.
have to pay the principal back.
And to be clear, the 5% that Mr. Smith was getting was from the charity. That's the
Was from
interest
the
on
charity,
bond.
absolutely. So a
Yeah.
lot of times
Yeah.
they might do it like I said, a student housing project is an example. So that creates an income. So Mr. Smith
Yeah.
is confident that he can get paid back. Or we
Right.
talked about the campus organization earlier. They have huge cash flows coming in from a variety of places. So the donors there hopefully are confident that there's cash to make their payments.
Fantastic idea. How do you find that's I really, really like this idea. And if you want more information, I'll be giving Walt's contact information before we get off this Scotch talk, and you can ask him about it. What how do you find the people? This is probably going a little bit outside your area of expertise, but you may have some sense of like, how do you find people with appreciated assets, or identify them in your file, or how do you bring up this possibility as a nonprofit? Do you have any? Have you seen some examples there that you think
Sure.
are well done?
Yeah. So the campus organization I keep coming back to. So this is now a proactive part of their repertoire, if you will. So they
Mm-hmm.
have development folks that are going out and preemptively talking to people about this idea.
Right.
So I mean, you can send out materials, you can have webinars, you can do all the normal stuff. But the other thing we found is helpful is just keep your ears open. So if you're a development officer and you're having a conversation with someone and they say, oh, how's your life going? Well, it's pretty good, and I'm kind of getting to the age where I think I might want to sell my business, or boy, the real estate market's hot
Right.
as can be, and I just got this fantastic offer on this building I own, or I think it's time to sell my Apple stock or whatever. Then you may say, here's an idea that you may want to consider. So some of it is being aware of the opportunities so you can share them, when the opportunities seem to be to ripe for that sort of idea.
What's your opinion? That's by the way, I totally agree with that. That's right. You can, if you just plant that seed on your website, materials, newsletters, etc. Like you just never know, and especially if your files bigger, even if you're just getting started, and someone wants to help you, that could with some significant seed funding, that could be a really good option.
Well, and
I
and I think it's time well spent for
generally
the
generally
nonprofit.
speaking, people don't think about that.
Yeah, and I think it's time well spent for a nonprofit
Yeah,
because people doing this aren't giving $1,000; they're giving $1 million or $10 million.
yeah,
So it's
exactly.
it's really going where the big fish are. So hopefully that the return on investment or return on time is pretty substantial.
That's right. Uh, well, maybe that's a good lead into one of my next questions, which is, what do you and your read of the future of the market philanthropy? What's your read, Walt, on where nonprofits should concentrate their future fundraising efforts?
Well, I've seen some of the statistics you talk about where the smaller donors are starting to be harder to find. So, I mean, if I were a nonprofit, I'd go after some of the bigger donors, and I'd be aware of some of these financing ideas, not necessarily that you're going to use them, and maybe you never will, but like the school that we talked about that did the bridge loan financing, um,
Mm-hmm.
you know, but for that, they probably couldn't be building. Well, they're now completing this particular school building. So without this idea, they'd still be stuck in a neutral gear, if you will. Um, and financing
Yeah,
takes a while to put in place, as do good fundraising programs, as does anything else. So having these ideas in the back of your mind, or at least knowing what's available, can help inform conversations. And whether you act on that or whether it makes sense to your organization is another story. But knowing the ideas, knowing the arrows in your quiver, will
yeah.
probably serve you well.
Do most nonprofits have this expertise in house, or do they usually, um, like many people are talking to, they have a plan giving consultant they talk to, when somebody has something kind of, they want to set up a charitable remainder trust or something like that. Um, do you find that people would generally have this expertise in house, or are they usually working with somebody like in your industry to figure out the best way forward?
Sometimes they do, but I find a lot of the organizations we deal with are relatively small to modestly large. So they may
Mm-hmm.
do this type of financing, once a generation, or these projects don't necessarily come around every day.
Right.
So if they have experience, it may be stale, or maybe they've never done it before. So it's nice to have someone who can walk them through it, or answer their questions, or whatever the case may be. And a lot of the folks that we work with, they may have come up through the nonprofit, like on the I don't know, the operating side, or the education side, or whatever. So sometimes they have finance backgrounds, sometimes they don't. Sometimes they have development programs or backgrounds, sometimes they don't. So it's kind of a mixed bag, to be honest.
I would think mostly that expertise does not live in house, to answer my own question.
Yeah.
Sorry if I'm breaking up, I apologize. I'm probably gonna switch my network here after I ask this next question. Christina asked again, hey, would wealth screening your database, I think is what you're, well, no, you're just looking at outside databases. Yeah, I don't think you're generally going to go find people outside your current file who are going to be prospects for balance sheet philanthropy, unless they're somehow close to you or close to somebody who's close to you. Now it's probably a little bit different. Well, you can answer this question because there's a chance to make some money on this, but there's got to still be pretty heavy mission alignment, I would think, and some pretty good trust built up.
I think so. Yeah. I mean,
You
someone
agree,
who's,
Walt?
yeah, they're doing this. I mean, they hope it's a safe investment. They think it's a good idea, but they think it's a good idea in part because they know and love you, and this mission is near and dear to them. So I think to find someone who has never been involved in your organization, is going to be pretty hard to do for an idea like this. It involves some trust and relationship and history and connection, and all those sorts of things.
Yeah, everything depends on where you are in your own life cycle. I get that. The ideal is you're building a pretty broad donor base. That's where the small fish people who look like small fish, some portion of them become big fish or can become big fish. And one of the ways they can become a big fish is in this way, not just by just straight gifts, right? But by doing something, partnering with you in a, for a special to finance a special project. And we are talking here, just to be very clear, mainly about capital projects, Walt, or have you seen people do this just for program expansion?
You can do both. So the campus one that I keep referring to, that was pure operating. That was pure program expansion. So
Should
they
pure
need to
just like
hire
we want to
people.
do more stuff,
Yeah, we
just
need
to
to
do
get
more
on more
stuff. Wow.
campuses, and that means I need to hire more people,
Wow.
and I need to fly them there and pay for their housing, and on and on and on. So that was pure operations. But a lot of times, for various reasons, just because the projects are bigger, and and have some sex appeal, like that nurse training center we talked about, more often than not, those need big dollars right now, and so it just seems that capital projects kind of fit. And then tax exempt, it has to be a capital project. You can't use tax exempt for operating. So
Got it.
there's a distinction
Yeah.
there.
Yeah. Are there not kinds of nonprofits or projects or that you think are not good candidates for doing for really pursuing um financing of special projects? Like what who'd you say like, hey now, you're probably not the right candidate?
Well, I always say, imagine that you're going to a bank and actually turn it around. Imagine someone's coming to you and you're the bank officer. So your livelihood depends on you making good loans. Would I make a loan to my organization? And if so, why? And if not, why not?
Mm-hmm.
So, that's where someone like us can say, well, these are the things they're going to ask, and these are the strengths, these are the weaknesses you may want to address. But again, just imagine, this person's relying on me to pay them back. Can I prove to them and myself that I'm a good risk? So that cuts across all sorts of different
Yeah.
categories and nonprofits, et cetera. But that's kind of the first screen, if you will, that I sometimes recommend.
And then my second question, okay, then my question that builds on that is um to prove I'm a good risk, is it enough to have a record of steadily increasing annual fund giving? Or do I have to have some sort of, but let's say I only lease the building that we office out of. I own computers and some paper. I don't own a lot. I don't have a lot to offer for collateral. Is that enough or is that not typically enough to access financing?
Well, it would depend on what you're using the money for. So let's say that you were leasing a building and you wanted to buy the building.
Mhm.
So do you have cash flow to make the payments from day to day? And then if not, is the building such that if I sold it, I could pay myself back? A lot of times too, lenders want what's called skin in the game. So let's make
Right.
up a number. If you're borrowing, 10 million from them, then they're going to want you to have some money at risk before they lose. So making up an example, maybe they say you have $2 million in it and I'll lend you 8 million, or you have 3 million in it, I lend you 7 million. But they want to make sure that, you're as interested as they are in making this thing work.
That's another
So
way which fundraising and financing can work together, I would
yeah,
imagine,
yeah.
right? Where you leverage a special gift from a donor to allow you to access financing that will allow you to then grow and do more whatever it is you do.
Yeah, and then sometimes we've done it like the school that did the bridge loan for their capital campaign. They didn't have the capital campaign pledges in hand when we did the deal, but this was a school that had been around for 100 years and had a
Mhm.
great reputation. So there seemed to be a sense that even though you haven't raised XYZ, we're pretty confident you can.
Okay.
Or another situation we're working on, the local bank says, I know who your donors are. And I think, A, B, C, and D donor, I know them and I think they're good for their pledges. So, we
So
will
if
lend based on their
things
reputation.
still get that personal
Yeah.
in the banking world,
Yeah.
that's actually incredibly refreshing to hear. I did not know the conversation would go to that because my next question is going to be is, do you want to work with a local bank, ideally a regional bank, or are most of these deals with Chase or whomever?
No, I mean, most of the deals we do are with the local bank or the regional bank. The larger
Yeah.
banks have become harder to deal with recently. That doesn't mean a year from now they won't be the easiest to deal with, but they seem to be pulling. This is my experience. Other people may have different experience. They seem to be pulling in their horns and only going after the biggest projects and the safest transactions. we don't me personally don't see them getting involved in some of these local nonprofits at least as much as they used to, but could change tomorrow.
That's fascinating. Um, and what about interest rates? We've sort of danced around that a little bit, but it's no secret that had we done this conversation a year ago, or well, just a year ago, I think, certainly a year and a half ago, we were talking rates that were historically low. I don't know what prime rate is at the moment. I'm sure you do. How does that? Have you seen this really start to slow down because of where rates are, or not?
Yes and no. I mean, certain new projects, people aren't doing because maybe, interest rates are a component of their budget and it's just, gotten too high. If they were refinancing to go from a higher rate to a lower rate, then certainly that's disappeared as well. But what we found is, some people, they have debt that's coming due from a previous borrowing. So they have to do something, right? And then a lot of the folks, they're too pregnant, if you will, with their project. They've already raised the money, they promise it's going to happen. They really need this school, this whatever to be built. So they're kind of going to go forward no matter what. And then some people, like I said, it could be, construction costs have gone up. They didn't plan to borrow money, but now they need to because there's a gap and they need to fill the gap somehow. So it's probably a little slower, no doubt about it, but it hasn't come to a crashing halt because good projects still need to be built. And, there's folks out there that want to do them.
What would a tax exempt financing rate be today?
Um, for
Ish.
10 ish, for a 10-year deal, probably 4.5 to 5%.
So it's
It's
still not
still
bad. I mean,
it's still not
if we
bad.
hadn't been spoiled by 3 years or 5 years of craziness, we would have thought 4.5 to 5% was a perfectly reasonable interest rate.
Yeah, not too many years ago, we were doing
Yeah.
10-year tax exempt deals at below 2%. So
Right.
yeah,
Yeah.
that was kind of a wonderful time for those who could borrow
Yeah.
then, but it's not
Yeah.
the norm, unfortunately.
No, 4.5 to 5 though is still not bad. Not bad
No,
at all.
no.
Is there anything else with Planned Giving where this kind of bumps up against that, or would you recommend that Planned Giving officers specifically sort of are they the right people to add this idea, balance sheet philanthropy, finance, et cetera, to their quiver? Where should it live in an organization from your
Well,
perspective?
plan giving for sure, because again, if you're having a conversation with someone, it'd be great to, if they had it, we're selling my business, I'm selling my building, to say, here's a great idea that may help you and help us. So at the very least, I'm sure they're going to appreciate, knowing there's another option out there. The other thing too is, like we said, we're finding more and more that people are facing gaps in their
Yeah.
financing to get a project done. So we're getting more and more calls from development officers saying, geez, I thought we were going to be able to pay for it from our own resources and what we're fundraising, but now we're $1 million short, 5 million short, 10 million, and financing that we used to think was totally unnecessary is now an
Mhm.
absolute component for us to succeed. So again, being aware of the
Yeah.
options, even if you never use them,
Yeah. Yeah.
you can talk to your board, you can talk to your leadership, you can, ponder yourself just to make sure, all the options are on the table, and then choose what you like.
Is that another first step that people need to make, early step besides you have to have a vision, sounds like to me, number one, of what it is you want to do. Either it's this incredible growth vision like your campus-based uh, organization that you've worked with, or it's a building that you need a capital project. So that's number one. Number two, you got to be able to identify people who might be partners for you or not, or maybe it's just a bank, actually, in that case. But is another part of it that is it typical that a board needs to be signed off on this as a strategy going forward?
Yeah, I think so. I mean, depending on the size of the organization and the size of this effort, but yeah, typically the board, certainly senior leadership is going to be involved, because this is a pretty big effort, and if you're taking on outside debt, it should be taken on with the appropriate amount of prudence and discussion and consideration and all those sorts of things. So yeah, I think you want folks to buy in, absolutely. The other thing too is we found is sometimes if you're thinking about a project, it's good to know if you ever need financing, is that possible? I mean, maybe you go to a bank or whoever and they say, wow, this is a real no-hoper, or they may say it's a slam dunk, or I'd love to do it if you can do X or Y. So that kind of reality check idea is probably better to do earlier rather than later. So
Yeah.
um,
Yeah.
that's probably
Yeah.
time well
Well,
spent as well.
so yeah, I think one of the big takeaways for me here is don't let gaps between what you have raised so far and what you need necessarily stop you from moving forward doing what you need. There's a decent chance that there's a way forward through tax exempt financing or balance sheet philanthropy, one of these things we've been talking about, um, to creatively move your project forward, regain, sustain momentum, thus driving more, even increased donor interest going forward, um, and um, uh, and moving forward your mission. I mean, I think that's the takeaway that people should have here.
Absolutely. Yeah.
Awesome,
Yeah.
awesome. Walt Coughlin, thank you for doing this today. I did not yet finish my soda, but that's probably for the best. It's not yet 2 o'clock my time, local time. Your company, which, as I said before, has been around since 1932. So this is no fly-by-night operation. You're third generation there. Coughlin and Company.com. Is that correct?
Yeah. COUGHLINANDCOMPANY.com. Sorry it's
And
so long, but yeah, that's what it is.
that's all right. And you only have to type it in once. And
Yeah.
your email address, Walt?
It'd be Walt, WALT, at
CoughlInandCompany.com.
COUGHLINANDCOMPANY.com.
And you
Correct.
can always contact us at Amphill. We can put you in touch with them if you're interested in talking to them. And thank you, Caitlin, for putting it in the chat right now. So whether you're watching this now or watching it later, you can follow up with them, find out more about how to do this. Don't let like a for-profit. Sometimes you need to access financing to get done what you need to get done. Sometimes it's a smart business move. And you can discuss that yourself. There's a bank or somebody on the other side that's going to help you figure it out whether it's a smart business move too.
Right.
So I encourage you to consider that for your capital needs. There's so many schools that I work with that aren't thinking this way yet. Maybe churches that I've seen that aren't thinking this way yet, especially with rising construction costs. Everybody complaining that they're double, like you said before, Walt, what they were when they started to scope stuff out. Um, shouldn't necessarily stop you from going forward. There may be a solution. So thank you, Walt, for
Thank
joining
you.
us and explaining all this stuff to us.
Thank you. I appreciate
Thanks
your
for
time and good
speaking
luck
bank.
to everyone on the
You
call.
taught us a little bit of bank today. We appreciate that.
There you go. My pleasure.
All right. Thanks all. Thanks for joining us. We appreciate
Thank
it.
you. Take
Take
care.
care.
Bye.